I'm Dr. B, and yes, I'm a real ER doctor, so you may be wondering, what am I doing here in this space? Well, after years of pain from sports injuries, I listened to my doctor and had to pivot into a career that would keep me off my feet as much as possible. I also have a degree in finance, and so it was a natural transition to join Verified Investing. I'll share my prescription for becoming a successful investor right here on the Market Pulse.
Welcome to the Market Pulse. I'm Dr. B here at Verified Investing. Today we're going to be doing some housekeeping. We're not really going to be reviewing charts or levels or things like that, but we're going to be talking about types of orders which are equally as important. Bid-ask spread, limit orders, market orders. What do all these things mean? Very important to understand what they mean because they can affect your profit or loss at the end of the day. So market orders, really the way to think about this is in the way of a sentence, right? Get me in or out as quickly as possible. I don't care about the price. So what does that mean? So if we go to the next slide here, I'll just do a little rendition. Let's say that the stock price is at $100 right now, and we see that the stock is at a good level, a good technical level, and we say, you know what, let's put a market order in to buy the stock. We say, okay, market order, market, buy, right? And let's say that the stock has a bid-ask spread of, let's say, $1. And we're going to talk about bid-ask spread in the next couple slides, but let's say that the current ask price for the stock is $100.50. Let's say that you wanted to get in at $100.25. But you say, you know what, I want to get into this stock now. You click Market Buy. The order gets filled at $100.50. Well, what happens? You paid up 25 cents, but you may be okay with that because you wanted to get into the stock. Let's say on the flip side that instead of a market buy, you wanted to short the stock, right? So market sell, right? So market sell. Let's say again that the stock is currently at $100, but the bid-ask spread is about 25 cents. So you want to short the stock at $100.50, but you say, get me in short on the stock. Let's say that the bid price is $100.25. You get filled here at $100.25. But the price actually now is $100.50. Well, what happens is you get a 25-cent worse fill on your short position, okay? So as we go through this, you're going to understand how this works and why this matters in the next couple slides. So let's erase this and go to the next slide here. So limit orders, right? I only want this price or better, right? So what does that mean? Let's say that, again, the stock is at $100. And let's say that I want this stock, I want to put a buy order in for this stock at $99.50. So you'd put a limit buy order at $99.50. The stock is currently at $100. Let's say that this is the level of $100. Let's say the stock comes down here, and let's say it bounces right at $100. Well, your order wouldn't get filled, okay? But let's say that the stock comes back down here, and it hits this $99.50 right here. Let's say that this is the level, $99.50. Now, if the stock is not thinly traded, it's an actively traded stock, and it's a reasonable amount of shares, then you will likely get filled at this level. And let's say the stock bounces back up, let's say to $100.50. Well, now you're up $1 per share on that stock, right? From $99.50 to $100.50. So that's what a limit order is, right? I only want to buy this stock if I get to my price. Otherwise, don't buy the stock, okay? Same thing on the short side. Okay, let's say we have a limit sell order, and let's say that the stock price, again, is $100 right here. And let's say you put your limit sell at $100.50. The stock comes up, doesn't quite get there. You wouldn't get filled here at this level, right? You wouldn't get filled. But let's say that the stock comes up to here. You get filled on your order. And now you start to come down here to $99.50. Well, you're short the stock. Your limit order got hit. And now you're up about $1 per share on the stock. So that's what a limit order is. That's the difference between market and limit orders, okay? And I know market's a little bit difficult to understand when you don't understand the bid and the ask spread, but we will talk about that. So what are stop orders? So stop orders are essentially, an order that says, get me out of the market as quickly as possible. I don't care what the price is, right? Okay, so a stop market. Let's say you have a stock priced here at $100, right? Here's your level, and you say, oh no, the stock is dropping. I'm long on the stock. I want to put a stop market order in right here at $99.50. All right? But let's say that the stock is falling so quick that the next buyer is down here at $99. Well, what happens? You've just clicked a stop market order. What happens is you end up getting out here 50 cents lower than where you planned to get out. So that's a 50-cent loss per share on that stock. At the same time, let's say that you had good intuition, you had good technical levels and a good technical reasons to get out of the stock. Let's say that stock continued lower here down to $90. Well, okay, you lost 50 cents on that trade, right? But you prevented yourself from losing more money, right? So that's very, very key. And the same thing works on the upside. Let's say that you were short a stock, okay? We're right here at the $100 level. You're short a stock and you say, wow, it's probably going to continue to go up higher. And you put an order out for a stop stop market at 150, but the stock actually comes up here, and now the stock is $101, right? You put the market stop in right there, but the next seller is right here at $101. So now you've lost 50 cents per share because of that bid-ask spread. And now what happens is the stock continues to go up. Well, to say $110. You've saved yourself about $10 here per share, but really, because that bid-ask spread is so far apart, you lost 50 cents per share there. But in general, if you want to get in or out of a stock very quickly, you have a market buy or sell, and then a stop market or stop market buy or sell. Okay, so very, very important there to understand that. So what is a stop limit? Really, if you're long, the way to think about it is, I want to get out here, but if the stock goes lower, then don't sell. That's too low of a price. I'll wait until it comes back to that price. So let's draw that out on a graph here. Okay, so a stop limit price. This is a bit more complicated than the market order or limit price. Okay, there's a couple things here to understand. So let's say that we're long the stock here at $100. All right. And let's say that the stock comes up here to $110. So you're in the money about $10. You say, you know what? I think this stock's going to go higher, but I want to protect my position in case this stock goes lower. So what do? You put a stop price at your break even, let's say, and let's say your stop price is $100. Right? So that's one part of a stop limit order entry, okay? The second part is a limit price, right? So if the price comes down here to $100, the order starts to trigger. It starts to sell your shares as quickly as it can. However, if you say, I really think that over time this stock's going to get to $200. Don't sell if I get below, say, $99, right? So your limit price would be $99. Well, what can happen if this stock really moves down here quickly? Let's say you had 100 shares long right here. 100 shares long at $100. Pretty simple, right? Let's say that when the stop price started to trigger, you were only able to sell 50 shares in this area. 50 shares, right? So you're still 50 shares long, and what happens is when you get below this 99 limit price, you stop selling your shares. So you're still 50 shares long right here, right? The benefit to this is if the stock goes up, right, now you're in the money again. But if the price keeps going lower and you really wanted to get out here at $100, those shares will still get drawn down, say to $80, $70, $60, $50, depending on where the stock goes. So really it's kind of a catch-22. You need to monitor your positions and understand, you know, what happened here. Did you get out of all your shares? Did you get out of a quarter, 75%, or did you get out of all of your shares? So very, very important to understand how these orders work. All right, so you're probably wondering, why is this so important? I just want to put in a market buy or a market sell. I just want to get it in and out whenever I want. Well, the bid and the ask spread is really important to understand. If you have a stock that has a bid-ask spread of $1, $5, $10, that can really affect your P&L at the end of the day, right? So let's do a couple definitions here, right? So in general, a large actively traded stock has a very thin spread, usually of a cent, a couple cents, usually not more than 5-10 cents, okay? Like Nvidia, Apple, all of these stocks are very actively traded. They're not thin stocks, whereas if you have a small, thinly traded stock, they can have a large bid and ask spread, right? So let's talk about the differences between the bid and the ask. The ask is the lowest price a seller will accept for the stock, right? The bid is the highest price a buyer will pay, right? Think about real estate. The listing price is $100,000. That's what the seller is asking for that house. Whereas a bidder on that house, they may bid $90,000. That's the highest that they'll pay for that house. So just think of it this way. In general, the ask is higher than the bid, right? That's just the way to think about it. So again, what happens if this bid and ask is far apart? Well, take a look. This is MSTR. This is a real picture of the bid and the ask spread today on MSTR MicroStrategy. You can see that there's a $5 bid-ask spread. This is what the buyer is willing to pay. This is what the seller wants to sell for. That's a $5 spread. Now, sometimes you can have a $10 spread on MSTR, and I use MSTR because, this actually, I've seen the highest bid-ask spread that I've ever seen on any stock, and this is just partly because it's a highly priced stock, but again, this just depends on the market conditions. So let's say that you place a market order to buy this stock, and let's say you want to buy here at $16.70, right? So if you want to get into this stock, what price will you get in at if you put a market order in? You'll get in at $16.75, so $5 higher than you wanted to, right? You wanted to get in at $16.70, you put a market buy order in, you get filled here at $16.75. Now, and again, on such a highly priced stock, maybe not that big of a deal, but this is something you always have to look for before you enter a stock, okay? So again, just to illustrate that, price is $16.75 is the ask. The bid here is $16.70, right? And let's say you want to get into this stock now, market buy. You will fill here at $16.75. So you'll be $5 out of the money compared to your $16.70 where you wanted to enter. Let's say that you wanted to short, market sell. What happens? You want to short higher, right? You want to get the best possible fill on a short. You're saying, I want to get into this stock at $16.75, but I want to get in right now. Well, where's a buyer? Right here at $16.70. So you get filled at $16.70 when you market short the stock, okay, or market sell the stock. So really, really important to understand how this works. So again, let's say, using the same example, MSTR, here's your bid and your ask spread. Okay, what happens if I place a limit order on this stock? Well, let's check it out. Again, $16.75 is your ask, and $16.70 is your bid. And let's say I put a limit buy in on this stock, a limit buy. So the sellers are sitting right here saying, I only want to sell this stock at $16.70, right? Well, let's say the market, the price comes down, and now the bid is $16.65. This is your new bid, this is your new price, and the ask is now $16.70. And you put a limit buy order in at $16.71. Well, you got filled there. Most likely, you would get filled because the price came down. The sellers are now willing to sell under $16.71. You got filled here at $16.71, most likely, right? Depending on market conditions and volume that's being traded. And the same thing on a limit sell, right? Let's say that you put in a limit sell order for $16.75, right? And let's say that that's the current bid in the ask, right? Someone is only willing to buy this or let you borrow at $16.70. But now what happens, the stock price goes up, right? And now the ask is $16.80, ask, and the bid is $16.75, and you put a limit sell at $16.74, you got filled on the short side in this case, right? So very important to understand this. This takes practice. Study this. Again, go back, learn the definitions of the bid and the ask, understand the difference between market orders, market buys, market sells, limit buys, limit sells. Understand the difference between stop limits and stop markets, right? Very, very important to understand. If you understand this, you can save yourself a lot of money that you will lose if you're always clicking market when there's a big spread. The other thing to understand is this. All right, so this is very important to understand. Let's say that you want to get into a stock right now. Let's say that the ask price is $100, okay? And let's say that the bid price is $99. And you put in a market buy. So you have your sellers here at $100. But let's say that for some reason, maybe it's a thinner stock, and this order gets filled here at $100. And now there's no more sellers until $110, right? So $110. This is really, really important to understand. Now the new ask is $110. And if you put a market buy in at the same time that this ask comes up to $110, right? When you still have bidders at 99, your order will get filled most likely at the ask, $110. So you'll immediately, like that, be out of the money as soon as you get filled $10. This is the risk with a market order, okay? It essentially says, get me in as quickly as possible. I don't care what the price is. And if there's a kind of a temporary bid and ask spread of several dollars or $10 in this case, you will get a horrible fill on your stock. Now, again, you're $10 out of the money, right? Let's say the stock is still trading here at about $100 or $101. You're immediately out of the money as soon as you buy that stock, and you're working uphill, as soon as you get in. So very, very important. The same concept works on the short side. Let's say you're trying to short at $100, you market short, and all of a sudden the bid is $90. You'll be $10 out of the money. So very, very important to understand this. Go back, watch this a couple times. A little bit difficult to explain, but somewhat complex when you're first learning it, but very, very important. So I hope you enjoyed that. So I hope you enjoyed that episode. Again, this was somewhat of a housekeeping episode where we talk about some of the details and the intricacies of the stock market. There will be a sequel to this episode talking about time in force, right? Good till close, day entries, extended hours entries, and we'll loop in this episode, the bid and the ask spread, with that, so you can understand kind of how all of this works in unison. So again, I hope you enjoyed that. Go back and watch it once or twice so you can really internalize these concepts, practice these things on the charts. Start with very small amounts of shares or paper trade to learn this concept. Again, I hope you enjoyed that. Thanks for watching. I'll see you next week.